So you're moving to the UK. Welcome. But also, you're going to be welcomed by HMRC, who are going to want to tax you on your worldwide income. Check out this video as I go through all of the details. Hi there, my name is Simon Misiewicz from Optimise Accountants. I'm here to help you grow your wealth whilst reducing your tax liability when you're moving to the UK. That sounds quite contradictory, bearing in mind that UK is probably one of the most highest income tax banded countries in the world. So I'm going to explain all the pitfalls that you might fall into if you're not careful. Now, we're talking about moving to the UK and being taxed in the UK. Now, you may need to understand whether you need to submit self-assessment tax returns. Now, rather than bore you through that level of detail in this video, I've created one specifically on that point. So check out if you need to file a self-assessment tax return. The link will be appearing above my head and below this video as well. Now, if you do need to be registered for a self-assessment tax return, or indeed you know you've got tax to pay, you will need a unique tax reference number. A UTR is a unique tax number for you as an individual. So if you're married, you'll have two, one for you, one for your spouse. You will need to obtain a UTR by contacting HMRC on 0300 200 3310. And if you need a national insurance number, which you are going to do if you need a self-assessment tax return, again, you will need to call a number, but not the same one. So you need to contact another department within HMRC, and that number is 0300 200 3500. Both numbers are obviously in front of you on screen. Now, once you've got your UTR, your national insurance number, you'll have other details that you'll need to tell HMRC about as well, which is basically your date of birth and your postal address. Now, when it comes to filing tax returns, you need to understand that the tax year end for the UK is the 5th of April. So it basically starts on the 6th of April, then finishes on the following 5th of April. That might be different to your tax year in your country, and therefore you may need a straddling period of adjustment if you are going to be taxed on your worldwide income. You can file paper returns. Yes, paper returns that still exist for HMRC. That needs to be filed within HMRC by the 31st of October. But for most part, people file online. And people do leave it until the 31st of January, which is the deadline, to file your online self-assessment tax return. Now, if you are going to leave it until that date, you need to be mindful that you also need to pay your tax liability on that same day. So it doesn't really give you much opportunity to understand how much tax you've got to pay and then save up for it. So my view is be proactive as much as you can possible and do your tax return nice and early after April, and it gives you plenty of time to save up for that tax payment to HMRC. Now, what we do need to bear in mind is if you are in the UK and or I should say you are in the UK for less than 183 days, or you invest in the UK but stay in your host country, what tax liabilities will you have? Well, we have income tax liability, which is based on the profits made or income generated from your investments. That will be subject to UK tax. Now, you do need to think about this. Is it also going to be subject to tax in your country? That's something that you need to work out. In some countries, you don't have to pay tax in your host country. In some countries, you do. So Hong Kong, no. In the USA, yes, you do. Now, capital gains tax, again, if you are going to dispose of assets in the UK, again, are you going to be only paying tax in the UK only, or are you going to have to pay tax again in your own host country? And following that, you have something called inheritance tax. I am going to go through inheritance tax in a little bit more detail because that is death taxes and it's a little bit more complex. So I will talk about that later on. But again, if you are non-resident in the UK, then IHT for UK tax purposes is only based on your UK assets, not your worldwide assets. Now, the complexity really comes into it is if you are in the UK for more than 183 days and then you become resident, your income, your income that you generate, whether that's in the UK or across the globe, could be subject to UK income tax. We'll go through an example of that later on. It's capital gains tax. If you make a disposal of an asset in your host country and you're now resident in the UK, that too could be subject to capital gains tax, which you may not be paying in your host country at all. So all of a sudden, you're paying now a tax that you didn't have to pay at all before. Inheritance tax, this is huge. Inheritance tax is a minefield. Death taxes. Once you go over a certain band in the UK, you will be subject to 40% inheritance tax. That's painful enough when it's just based on UK assets, but once you become resident in the UK for a period of time, which I'm going to go through an example in a second, then your worldwide assets could be subject to that painful 40% inheritance tax. So what makes you resident in the UK? Well, you could be resident because you spent more than 183 days, but there are two options here. The fact that you're UK resident gives you a choice. Do I want to be taxed on my UK income for income tax purposes in the UK? Or do I want to be taxed across my worldwide income generated assets, employments, etc.? There is probably a good reason why you would want to be taxed in the UK only, as opposed to worldwide income generating assets. And sometimes you might be happy to say, well, hold on, I'm happy to be taxed on my worldwide assets because I've only got UK assets anyway. So it does depend. Now, if you are going to say to HMRC, hey, I don't want you to tax me on my worldwide income, they will give you an income tax charge known as the residency remittance basis tax charge. Okay, we'll go through an example of that. Inheritance tax. So this is a death tax, which is subject to 40% once you go over your inheritance tax allowance. 40%. I have to say that because that's probably ridiculously high. I think it's only Germany that pays 50%. But that's scaled. So UK is pretty much, I think, is the highest tax rate for death taxes. Now, if you're resident in the UK for less than 15 years, then inheritance tax will only be subject to UK assets. But if you're in the UK for more than 15 out of the 20 years, then you will be based on the inheritance tax across the globe. So you might want to check out your diary and pin a date in your diary that says, okay, it's the 14th year. Let's make a decision. Do we stay in the UK and accept that our worldwide assets would be chargeable to inheritance tax? Or do we, well, bugger off basically and go to a cheaper country that has no inheritance tax at all? So we'll come back to income tax as the example. Now, I did say you could say to HMRC, look, tax me on my worldwide income, not a problem. Or if you have income generating assets outside the UK, or you are highly paid in a different country, you might say to them, well, do you know what? I'm happy to pay your remittance basis charge. Now that charge does increase. As you can see by the first example, if you've been in the UK for 7 out of the 9 years, you will have this remittance basis charge of £30,000. Now, what we need to bear in mind here is that there will be an additional tax for the monies that you bring into the UK. Okay, so that's the real important thing. But you would also have this £30,000 income tax charge as well as the tax you've paid on your UK assets and employments. That increases from £30,000 to £60,000. Wow. Once you are in the UK for 12 out of the last 14 years. Again, any money you bring into the UK would also be subject to an additional tax. Before we do, please know that we do have an online community to go where we talk more about this in a lot more detail to help you understand how much tax you will be paying in the UK and how you can reduce it. There are a number of videos more detailed than this that talk about this subject. We've also got tax calculators which you can use online to work out your tax liability and indeed how you can save those taxes as well. And I'll be live every Wednesday for you to be able to ask your tax question of me. And this is all for $9.95 per month and is a 7-day free trial as well. So why not register today and save tax tomorrow? So back to this example then. So let's imagine that you've got £80,000 worth of UK income. You will be a high rate taxpayer. You will pay 40% tax, but I'm not going to be focusing just on that right now. What I do want to focus on is this £50,000 worth of income you have from your foreign country. Now, you may have different tax rates, but in this example, I've just looked at Hong Kong because it's easier for me to work out. And in the UK, you will have a high rate tax band of 40%. In Hong Kong, you'll have a tax rate of 17%. So we've got now a higher rate of tax in the UK of 23%. What they will do is give you this nice $11,500 income tax in the UK based on money generated in a different country. Wow, that's a little bit harsh. Now, you could be saying, well, okay, I don't want to pay that. I'll have the remittance basis charge instead. Well, you may not want to do that. You may be better off if you've been in the UK for 12 out of the 14 years. You've got this £60,000 remittance basis charge. That's a lot more money than the $11,500 UK tax that would be applied to your worldwide income. So on that view, you need to do some calculations and you need to work out, should I be taxing my worldwide income or should I use the remittance basis charge? Let's go through another example now, whereby you have £150,000 in the UK, which would then be subject to 45% tax once you go over that amount. Now, you may have £1 million worth of income being generated from your foreign assets that you either leave there or you bring back to the UK and pay income tax on that money, if you're using the remittance basis charge, of course. Now, if that's the case and you say, well, hold on, actually, do you know what? I should be taxed on my worldwide income. So yeah, let's do the calculation. If you earn £1 million as an additional rate taxpayer, you will pay 28% additional tax to the UK HMRC. And that gives you a nice income tax charge now of £280,000. Wow. On £1 million worth of income generated. Now that £280,000 is a lot more than all of the remittance basis charges that you can see before you today. We've done a tax calculator for you to understand, well, this is my income, how much will I be generating from the UK versus my host country. You can do your calculation on there. This calculator is going to cost you $9.95 and it will tell you whether you should use the remittance basis or allow yourself to be taxed on your worldwide income. So it gives you a snapshot choice straight away of what method to use. So again, download that tax calculator. $9.95 will save you thousands. I have talked about inheritance tax in another video. Again, that link should be appearing just above my head right now. And indeed, the link will be below this video. I talk about what inheritance tax is in the UK and how much money you will have to pay to HMRC and by when. Now, don't forget, if you've enjoyed this video, give me a thumbs up. But more importantly, if you've got questions, then feel free to drop those questions into the comments box. I'll try my best to answer those within 2 working days. And don't forget to subscribe to this channel. We will be doing a lot more videos about foreign-based income in the UK and how it's going to be taxed. Now, if you want to discuss our services for your accountancy tax needs in the UK, then be my guest and book that call. Indeed, if you want a tax strategy call with me, Simon Misiewicz, don't forget to use your code YouTube25 where you can get a 25% discount off that tax consultation with me. Until next time, my name is Simon Misiewicz from Optimise Accountants. I'll see you again soon.